The backdoor Roth IRA gets talked about a lot, and for really good reasons. It's a really solid planning opportunity for high income earners who are above the income limits for direct Roth IRA contributions. But there are some situations where doing a backdoor Roth contribution, is the wrong move. And the third reason on this list that I'm going to talk about trumps everything else. I'm Devin Watts with Fallbrook FI, and in this video, I'm going to go over the 3 reasons not to do a backdoor Roth IRA. The first reason for you to not do a backdoor Roth IRA is because your near-term cash is just not in a good place. And what I mean by that, it's pretty specific. Think about things like estimated tax payments, a car down payment coming up, or an upcoming vacation, or just your basic emergency fund not being fully funded. Those need to come first. They really do. Somebody gets so caught up in the idea of doing a smart tax move, and the backdoor Roth IRA is absolutely a smart tax move. When really, though, their issue is they don't have enough liquid cash to absorb what life throws at them. For 2026, the contribution limit for a backdoor Roth IRA is $7,500 per person. So if you're married and your spouse isn't working, that doesn't preclude them. They could still do a backdoor Roth IRA contribution. And also, if you're over 50, that contribution limit receives an extra bonus. So you could add up to an additional 1,100, bringing you to a total of 8,600. But the point is, this is real money going into a retirement account. And that's money you typically don't want to touch until you're older, like 59. And that's when you can touch it penalty free. And that's the point. You want to save this money and allow it to grow and withdraw it in a time when it's penalty free. So if this cash reserve for yourself is thin and something comes up, you're either going to rack up a credit card debt or deplete your emergency fund, which is really the foundation to a stable financial plan. The backdoor Roth IRA will still be there next year. Even actually, it will still be there until the tax filing deadline in April. And so a fully funded emergency fund covering your near-term expenses, those are the foundation. And the big mistake here is not giving enough attention to all of those areas at the same time. And this is just one of those areas that just can't be skipped. Now let's look at the second reason not to do a backdoor Roth IRA. It has to do with having a credit card balance. This one is really straightforward when you think about it. Credit card interest rates right now are averaging somewhere around 20%. The Roth IRA is a long-term tax-free growth vehicle, which is genuinely valuable, but it is very hard to capture any investment return to beat a guaranteed 20% interest expense. Somebody can get so caught up focusing too much on the planning opportunity in front of them when really the issue is that high interest debt is eating away at their situation faster than any tax-free growth can offset. Pay off the credit card first, then look at the backdoor Roth. That's really the sequence that is meaningful. Now let's look at the third and final reason I would say somebody should not be considering a backdoor Roth IRA contribution. And it's where I spend a majority of my time talking to individuals and families about why they may not want to do a backdoor Roth contribution this year. And it's when somebody has an IRA balance sitting out there. This includes like traditional IRAs, SEP IRAs, simple IRAs, and rollover IRAs, any of those. And this one matters so much because it doesn't just make the backdoor Roth IRA less attractive, it can actually turn a tax-free planning opportunity into an unexpected tax bill for yourself. This is how it works. The IRS has what is called a pro-rata rule. This gets calculated on the IRS's Form 8606. It's essentially that showing when someone converts an after-tax IRA contribution, aka your non-deductible IRA contribution, to a Roth IRA, the IRS looks at all of your pre-tax IRA balances as of December 31st in that year you do the conversion part of the backdoor Roth. And then it ultimately calculates what percentage of the conversion is taxable to you. It is not just looking at the account you contributed to, it's looking at everything. Consider this example. Somebody contributes $7,500 after tax to a traditional IRA with the intention of converting it to a Roth for their backdoor Roth IRA. But they also had $100,000 in a rollover IRA from an old employer plan. The IRS is going to look at the total picture, roughly $107,500 in a IRA or in IRA assets with only $7,500 being after-tax money. So the vast majority of that conversion is going to be taxable. What was supposed to be a clean tax-free move looks to add something like $7,000 to their taxable income that year. That's a big mistake. And so the rule is simple. For a backdoor Roth IRA to work the way it's supposed to, all pre-tax IRA balances need to be at zero, no money in IRA balances by December 31st of the year the conversion happens. That means either rolling the pre-tax balances into your current employer 401k plan, which I would say is the most common solution. There are two other solutions, though, that I see with this. There's intentionally converting the full pre-tax IRA to your Roth. Yes, you're intentionally paying more in taxes because of the Roth conversion, but you'd free up your opportunity for backdoor Roth contributions in the future. Or option two is just to not do the backdoor Roth IRA until that issue of having money in an IRA is resolved. By the way, if you're married, this is on an individual basis. So if your spouse has a large IRA and you're thinking you can't do a backdoor Roth because of it, the other spouse can still do a backdoor Roth. The pro-rata rule is just for the spouse that has the IRA balances. And so if that IRA is in the way for one spouse, that doesn't mean the other spouse can't do it. The Form 8606 applies to each individual. So if you do a backdoor Roth, but your spouse does not, you're the one having to file the Form 8606. If both of you do a backdoor Roth, you both have to file Form 8606. And it's really important to know, tax laws change, income changes, family dynamics change, account balances change, and if someone's not paying attention to all of these areas, blind spots are probably going to be inevitable throughout the years. The pro-rata rule is one of the most common blind spots I see families get caught up with backdoor Roth IRA processes. And I would say not having a professional in your corner to help look over everything and to talk through this process with you, you can assume that you're seeing all of your blind spots. And I would say that's the biggest mistake people will make when they go through the backdoor Roth IRA. If this was helpful, give a follow to Fallbrook FI. This channel is designed to provide clarity for families who don't have time to figure out their finances on their own. And if you're stuck in the stage of earning well, but unsure if you're making the right moves to keep your finances in order, book a call with me using the link in the description below.